Hey everyone, and welcome back to the channel. It's Olivia and Ava here, your accountants, and today we're diving into a property tax trap that catches out so many people in the UK. The dreaded 60-day capital gains tax deadline.
Seriously, this is one of the most expensive and easily avoidable mistakes you can make when selling a property. A lot of people just assume that all their tax matters can wait until their annual self-assessment tax return, right? Well, that assumption can lead straight to hefty penalties, and nobody wants that.
In this video, I'm going to break down exactly what the 60-day rule is, who it actually applies to, what you need to report to HMRC, and crucially, what happens if you miss the deadline and how to avoid it.
So if you're thinking of selling a UK property or have recently sold one, you need to watch this.
Let's get started. Okay, so what exactly is this 60-day rule? In a nutshell, if you've sold a UK residential property and you owe capital gains tax, or CGT,
You now have a legal duty to report the sale to HMRC and pay any tax you estimate is due all within 60 days of the completion date. Yes, you heard that right. Just 60 days. This is a completely separate process from your usual self-assessment tax return. It applies even if you're someone who normally files your tax return annually like clockwork, or even if you don't have any other taxable income to report. Essentially, HMRC wants its share of the profit from your property sale, and it wants it quickly. This rule is a massive shift from the old system where you could wait until the end of the tax year. The window is now incredibly tight.
So who needs to worry about this 60-day rule? Well, it has a surprisingly wide reach.
It applies to UK residents who are selling a residential property in the UK. It also applies to non-UK residents who are selling any UK property, whether it's residential or commercial. The rules also extend to individuals, trustees, and even personal representatives who might be managing the sale of a property as part of an estate. Basically, if you are selling a UK property and there's a capital gain that isn't fully covered by a tax relief, this rule almost certainly applies to you.
Now, you might be thinking, but what if the property was my main home?
If you qualify for full private residence relief, meaning the property was your main home for the entire time you owned it, then you likely won't need to file a 60-day report. However, making assumptions here is super risky. For example, if you rented it out for a period or used part of it for business, you might only get partial relief, which means a report is required. It's always best to double-check rather than assume you're exempt.
All right, so what information does HMRC actually want when you make this report?
You'll need to gather quite a bit of detail to do this correctly. You'll have to provide the property address, the date you acquired it, and the date of completion. You'll also need the sale price, or the market value if it wasn't a straightforward sale, and the original purchase price. On top of that, you need to declare the costs of buying, selling, and improving the property, as these can be deducted from your gain. You'll also need to state any tax reliefs you're claiming, like private residence relief. And most importantly, you need to provide your own calculation of the capital gains tax you estimate is due. This means you have to do your sums early and accurately. Simply guessing a figure is a terrible idea. It will almost always lead to corrections later on, and that can open a whole new can of worms with HMRC.
This is the part of the process where people start to feel a bit uneasy.
You might have to pay a significant amount of capital gains tax before the tax year has even finished. Yes, you are paying tax on money that might have only just landed in your bank account from the sale. This catches so many sellers off guard, so it's crucial to be prepared for it. The good news is that this is an estimated payment. Any necessary adjustments, either for more tax to pay or a refund, can be made later when you file your main self-assessment tax return for the year. For instance, if you have capital losses later in the tax year, you can offset them against the gain and potentially get some of that CGT payment back. But that initial payment within the 60-day window is still legally required.
Okay, let's talk about the sharp end, the consequences.
What happens if you miss that 60-day deadline? The short answer is, it gets expensive. Missing the deadline will trigger automatic late filing penalties. On top of that, HMRC will charge interest on the unpaid tax, and that interest starts ticking from the day the tax was due. This can add up very quickly, and perhaps worst of all, it puts you on HMRC's radar, and could increase the chances of them scrutinizing your tax affairs more closely, which is a stressful experience nobody wants. Even if it was an honest mistake and you simply didn't know about the rule, you'll likely still be penalized. HMRC's stance is that ignorance of the law is no excuse. They expect you to be aware of your tax obligations and they are not known for being particularly lenient on this deadline.
It's also super important to remember that filing this 60-day report does not replace your annual self-assessment tax return.
If you're already in the self-assessment system, you still need to include the property disposal details in your annual tax return as well. The two systems must match up. Any discrepancies between what you reported in the 60-day window and what you declare on your tax return can easily trigger an inquiry from HMRC. So make sure all your figures are consistent across both reports. Think of the 60-day report as an advance declaration and payment, with the final definitive figures being confirmed in your year-end tax return. It's an extra step, not a replacement for your existing duties.
So, what's the safest way to navigate this tricky tax minefield?
First, as soon as you decide to sell a property, you need to identify whether capital gains tax is likely to be due. Don't wait until you've accepted an offer. Start thinking about it from day one. Second, calculate your potential CGT liability properly. Gather all your documents like the completion statements from when you bought and sold the property and receipts for any major improvements. Don't just guess. Third, make sure you report the disposal and pay the tax on time. Set a calendar reminder for 60 days from your completion date. Fourth, keep all your evidence and records safely. You'll need them for your 60-day report and your self-assessment.
And most importantly, get professional advice before the sale completes, not after.
An accountant can help you calculate the tax accurately and ensure you claim all the reliefs you're entitled to.
To sum up, the 60-day CGT rule is not optional, and it's definitely not flexible.
It's one of HMRC's strictest deadlines, so you absolutely need to take it seriously. If you've sold a property recently or are in the process of selling one, please don't leave this until the last minute. Get your ducks in a row as early as possible. We help people deal with HMRC every single day, so you don't have to face it alone.
If you'd like some help navigating the 60-day rule or have any other tax questions, please get in touch.
You can find our contact details in the description below.
Thanks for watching, and I'll see you in the next video. Don't forget to like this video and subscribe for more essential tax tips and tricks.